Welcome to Stockwatch with me, Ntaoleng Lechela. And joining me to unpack your stock-related questions this evening are Devin Shutte from the Rebay Group and Aheesh Singh from MP9 Asset Management. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392 or on X @BusinessDayTV using the hashtag Stockwatch. Gents, thank you so much for your time this evening. Let's start off with the local picture, right? We have the national budget being tabled tomorrow. And I must say, I haven't witnessed so much calm, so much optimism before a budget when looking at the fiscus as well as the political front. If you were asking what you'll be focusing on when FinMin Enoch Gorongwana takes to the podium tomorrow, Devin?
Yes, I think calm is terrific when it comes to budgets. I think we had enough drama last year, so we'll take a calm lead up. Long may it last. But yeah, I think this is an important budget. What will be nice is the minister's going to announce quite a big windfall from the royalties and tax receipts from the miners, particularly the precious metals miners. That could be in the region of 50 billion. Which to kind of put in perspective is 2% of that will give you about the same. So it's material. But I think what we really got to be looking at is, what does government debt look like? What does that deficit look like? Does the primary deficit, which excludes financing costs, is that continuing to, primary surplus, I should say, continue to grow or not? And then also what the debt to GDP is looking like. All of this is going to be very key. I think it's key from a government bond rating perspective, what the yields will be there, so how much we finance at. I think from the ratings agencies perspective, and then I think one that's been pretty topical at the moment is, will the personal income brackets get adjusted for inflation or not? The poor PAYE payers for a while now, we haven't had those adjustments, so I think that will be pretty popular if that comes through. Maybe some adjustments to tax-free savings limits and that type of thing. But overall, yeah, I think, my first point, steady as she goes, is better. I think we are moving in the right direction fiscally, but yeah, it's a long way to go, and I think growth is still needed to really make the picture look a lot better.
So, Devin, painting that picture, long way to go, but things are getting better. We are on the road of recovery. Aheesh, do you share the same sentiments?
Yeah, look, Devin put it quite nicely. There's not much really for me to add to that, except foreigners and investors locally and abroad are expecting good things. Let's hope that the rhetoric and the sentiment and what is spoken about speaks to that.
Yeah, and Devin touched on precious metal prices, higher precious metal prices boosting our miners, and that, of course, likely to filter through when it comes to tax, right? And talking about those precious metals, we have seen trading volumes increasing over at the JSE on the back of those miners that have been rallying. There has been a question here around that and how you view the JSE, Aheesh, where we are seeing better trading volumes, which will likely translate into better trading revenue.
Yeah, look, so what you're saying makes 100% sense. Over the recent past, you've seen the JSE share price and its operations sort of come down a bit. And now with higher, with higher precious metal pricing and South Africa being one of the larger commodity countries around, foreign investors want access to that. And one of the ways they get access to it more directly is through the JSE. And as a result, that increased volume will then lead to a higher profitability on the JSE and a higher share price in turn.
And the JSE also in a sort of a defensive mode as well, because yes, when we are seeing the trading revenues likely to be boosted, it has been investing in other streams of income, with the non-trading revenue also really showing strength over the past few years when looking at its financial results. Devin, are you seeing value there?
Yeah, I mean, it's hard not to like this business, I think, because it's got such a defendable moat. Though there are some competitors, their scale is still really a lot smaller. So, it's a type of monopoly. I think what you were referring to, the other operations there is the market data services and the like. Those are incredibly lucrative, but I think the trading is still the core.
Yeah.
And I think he's put it well where, you now have the foreigners starting to enter our bond market. Third quarter of last year was a record quarter for activity there. Perplexingly, we haven't seen it come into the equity market yet. But, if you kind of cast your mind back 8 to 10 years, and think about JSE retailers, they were really the flavor of the month with global investors. And at some stage, maybe not the retailers, but they're going to be coming for our domestically listed equities again. That bodes well for the JSE, and throw in a bit of volatility where, traders and hedge funds are a lot more active in the market. That definitely bodes well for their profitability. So, yeah, it is a good operation, and one we look at.
Yeah, and talking about SA Inc. stocks, just sticking with you, Devin, as you mentioned there, retailers don't seem to be the flavor of the month or the year anymore. What other sectors are you seeing doing really well on the back of, I guess, the rotation out of the US stocks and into emerging markets? We've seen property players doing really well, banks also faring well in this environment.
Yeah, so I'll take the kind of bigger theme of emerging markets first. Last year, we saw a massive rotation in emerging markets in general as a sector. That was really pleasing to see after, I think, 15 years of underperformance of developed markets in the US in particular. We think that with probably a structurally weaker dollar, that's set to continue. So that's good news there. And then drill into the emerging market we all love the most, South Africa. There are definitely opportunities here on a number of levels. You mentioned the banks. Those we think are looking really attractive from a valuation perspective, from a dividend yield perspective, and incredibly well run, still continuing to grow operations in South Africa and on the continent. So those are one to look at. We think food producers are interesting. I know there was a question on food producers versus food retailers. I think food retailers have been quite popular. I think food producers, although maybe a tougher business, I think the stronger ones definitely have the opportunity to deliver nicely. So those are two sectors. Clothing, I would be a little bit more cautious on. I think consumer discretionary spend is still constrained. I think we're going to need that economic growth we spoke about earlier to really come through. Maybe a few more interest rate cuts, a sustained lower inflation environment to really see that. And I think the cherry on the top will be consumer sentiment really needs to kind of ignite, and we haven't seen a lot of that yet.
Yeah. I mean, we've been talking so much about improving confidence, but that is taking some time to filter through to the regular person on the street like you and I. We'll circle back to that conversation around food producers. I want to get your sense on the SA banks, Aheesh. We've seen a lot of interest in Absa over the past year or so. Of course, when you're looking at share prices, that Absa has been the laggard when it comes to the share price movements, and a lot of investors piling into that. A lot of optimism around Kenny Fihla also stepping into that top executive position.
Yeah, so Absa has been one of our bigger holdings on the financial side, and we've held it for quite a while. I think investors are sort of front-loading the growth, or the optimism rather, that comes with Kenny Fihla's joining Absa. And I think he has a lot of experience at Standard Bank, and that experience will now drive Absa in a more strategic direction that maybe something it lacked previously. And the market's appreciating that, and I think you'll see it in the earnings.
Yeah.
And over the last 2 years, financials are where you wanted to be, because they saw quite stable and good returns. And it's a very, very different sector compared to, let's say, precious metals, because banks now have diversified the income largely to a point where non-interest income and interest income are largely equal. So in times where maybe interest rates are lower and you see net interest margin compression, you're making up for it with higher fees from deal flow and the like. So I think from a financial services sector, from the banking perspective, we are much better placed than maybe what we were a few years ago.
Talking about the financial sector and zooming in on the fintech players, Aheesh, there's also been a lot of interest around there. Just thinking of Lesaka's recent results, which were quite good. We do know that it's also concluding that acquisition with Bank Zero, I think it is. There's also a player like Capital Appreciation. What is it now? It's Araxi. So any interest when it comes to those players?
Look, Lesaka isn't something I've followed very closely, but I will say innovation is always good for competition, right? And Lesaka maybe doesn't have the scale of the larger banks, so it would be interesting to see how the bigger banks in South Africa, like Standard Bank, First Rand, the Big Four, how they position themselves relative to these lower cost service providers.
Yeah. I mean, we have seen some of those big banks snapping up those smaller fintech players over the past year or so. Nedbank has done the same with something like Ikoka, Capitec also doing the same. Devin, looking at the banks versus the fintech players. Before we headed over into the break, I spoke of some corporate action playing out in the banking sector. Do you expect to see consolidation moving ahead, especially when it comes to those smaller fintech players? Are we going to see the bigger banks snapping them up? Are we going to see perhaps the fintech players merging to create bigger companies?
And Tarling, I think possibly yes to all of it. I think it's a fascinating space. These fintechs are really incredible. The pure digital banks are gaining massive traction. And, you referenced the African Rainbow, Time Bank deal. I mean, you've got Discovery Bank, which is a all digital bank. You've got Bank Zero. So there really are a lot of competitors in the space. And I think if you look at a bank like Capitec, which didn't have a lot of the big legacy tech systems, what they were able to do in terms of delivery to clients and value-added services there was massively profitable to them. And I think the larger big four banks, call them the legacy banks, are really going to have to be quick on the draw to stay competitive in that regard. They've got these huge incumbent loan books and client bases, but increasingly that's not going to be enough. And they either going to your question, be acquisitive and buy these digital banks, or there might be consolidation, whatever the case is. But there's no doubt that digital and kind of client first is the way forward. And, even someone like MTN has got a fintech arm with financial services in there. So I think it might not be the domain of the banks alone.
Yes.
I think you might start to see other players start to come into financial services and compete in that regard. And ultimately the client wins. So yeah, we're happy with that.
Listen, everyone wants a piece of the pie there. Think of something like a Pepcore as well as ShopRite also with their financial services ventures. Sticking with you, Devin, and talking about M&A activity consolidation, there's been a lot of that in the food manufacturing space. Just your thoughts around what's playing out in that sector when it comes to consolidation. We do know of the Premier Rhodes Food deal, Lipstar also keeping us on our toes when it comes to a takeover.
Yes, definitely. And spoiler alert, I'm going to be talking about Premier later as my stock pick.
Okay.
But absolutely, these companies, they rely heavily on the strength of the brands. So, when they were purchasing these other companies, they're buying growth, but they're buying an increasingly loyal stable of brands and the clients that come with those. So, to my mind, it makes absolute sense. There's also operational efficiencies they often get in terms of distribution and in terms of capacity of production, that type of thing. Because the reality is it's a fairly low margin business. And so they have to get scale in order to be able to continue to grab market share. that's kind of the game there. And I think you're seeing some of the real leaders execute on that incredibly well. So yeah, I think it makes complete sense to me what's happening, and I wouldn't be surprised for kind of that M&A levels to continue in the sector.
Besides M&A, let's talk about operations and what we're seeing when it comes to the earnings. RCL out with another trading update and warning of even steeper earnings declines. Aheesh, this, of course, on the back of what's playing out in its sugar business as well. That being really a structural issue where we are seeing the company being dealt a blow by cheap imports. Your thoughts around a company like RCL?
Look, it's very tough because the sugar business the sugar industry is quite cyclical, and RCL has proven to be a very cyclical business in the past in terms of earnings. And I think whenever you're dealing with companies like this, you can expect it. I think when you look to, just to Devin's point on the food producers, with all the acquisitions, it's sort of, you're speaking to these bigger, larger food producers wanting to capture some market share, all in pursuit of greater profit. But at the same time, the average consumer is very price conscious in South Africa. So much like retailers, food producers are also at the sort of race to zero, where your margins are getting very thin. So the only sort of solution as a larger food producer is to go and acquire something that fits into your brand. So I think it's a very competitive space right now, both in retail and in food production.
That brings me to my next question, right? There is a question here around food producers versus grocers. Of course, both looking to capture even more market share. We are seeing those grocery retailers really investing in their private label ranges, Aheesh.
Yeah, so let's take a different sort of spin at this, okay? So if we backtrack maybe 1 year and we say, okay, South Africa is in a interest rate cutting cycle. A typical investor would say, okay, we're in an interest rate cutting cycle, the average South African would have more money in their pocket. As a result, the easiest way to spend that money, or to live an aspirational life, if you would be to go and consume things like more clothes, buy maybe, instead of buying a house brand tomato sauce, buy a branded tomato sauce. But what did we see happen? And I think this is something we touched on before, is that money went on to online gambling. So if we look at this from an investment perspective, okay, what do we still have in South Africa? Even with low rates, we have food producers, retailers rather, where very few of them are experiencing like robust top line growth. An example is ShopRite. The top line growth is still quite robust. You've got Pick n Pay with Xboxer is in the opposite direction. So if we're looking at retailers right now, specifically let's go food retailers, we're going to have to look for companies that are integrated well internally. Their supply chains are good. They have deep market share. They have market share across South Africa. They have a whole lot of product offerings. They have sustainable margins, albeit at a low level. So from an investment perspective, if you were to choose from any retailer, you'd want durability of brand, you'd want sustainable margins, and you'd want high cash flow.
Devin, any hope for Spar? I think we seem to forget it when we do talk about the food producers. Of course, out with an update. I think it was yesterday. That update not looking good. Also dealing with, a rejig in leadership after Angelo Swartz resigned. That SAP issue as well in KZN. Yeah, things are not looking good. We've been expecting the tide to turn, but that recovery proving to be really, really slow.
Yes, it hasn't happened yet. And I expected this question. I think couple of things that are concerning there. Obviously, an abrupt leadership move is never a good signal. I think that SAP implementation continues to hurt, and then I think there's also swirling around today was talk around them battling to pay suppliers.
Yeah.
I don't know how much truth is in that. I think they've come out and said that it's not true. But I think the point is that the group is, they went overseas. A lot of those operations didn't work well, and now they're really trying to kind of piece through the aftermath of that. And I think as a group, they've really got to kind of go back to basics and figure out where their niche is in the South African market. As Aheesh correctly said, it's highly, highly competitive. And you kind of got almost the winner and everyone else at the moment in our market with ShopRite dominating, increasing market share, increasing margins, and the rest, unless they're really niche plays, really floundering. So it's hell of a tough at the moment, and the strong almost get stronger. And, when you are struggling for strategic direction, I think it's just a really difficult environment to be doing that in.
All right, let's shift our focus to the luxury market, right? An in-depth question here on Richemont. I noticed that since 2009, Richemont has generated a return for shareholders in excess of 20 times. Even though it's considered a single stock, it could also perhaps be seen as an index or thematic portfolio in its own right, just like a thematic ETF. Surely I'm only subject to global systematic risk inherent in luxury retail, but also hedged risk through multiple of its subsidiaries' earnings in various luxury spaces, contributing to the whole. It's more targeted, this is a long read. It's more targeted than the likes of a Berkshire or Naspers, but still resilient. Why not just invest solely in Richemont each month for the next 20 years? What are your thoughts on this investment approach, Devin?
Sure. I mean, as a portfolio manager, I think, it can work going into a single stock. But the reality is the risk you take on it as an investor is just probably too high.
Okay.
All companies go through some type of cycles. There's times when they outperform and underperform. They could have a misstep in a certain jurisdiction. They could have leadership issues. Maybe they make an acquisition that doesn't work so well. You think of Net-a-Porter in Richemont, specifically the online retailer that kind of fizz there. So, yeah, I don't like it. I mean, I like the idea of Richemont in a portfolio, and I think particularly the jewelry is doing incredibly well, and it's difficult to replace a company like Richemont with these brands that are some of them have been going for over 100 years. There is just a demand for luxury, and it commands huge margins for the producers or the owners of those brands, and I don't see that discontinuing anytime soon. So yeah, they're a terrific core holding in a portfolio, but I wouldn't say they make up a portfolio in its entirety.
You know what? I so wish I was the target market, but unfortunately, that's not the case. All right, let's get into your stock picks. Aheesh, where do you see value at the moment?
So PDD Holdings, this is one I've picked a couple of months ago, and it's subsequently fallen for many reasons. I think one is the global sentiment around tech. The other one is that top line growth seemed to have slowed a bit. However, it's still a quality business with high cash flow, and margins are still very, very stable. So I think once the sort of negative sentiment filters out, you can definitely see some price appreciation there. It's a solid business with a global reach.
Mm-hmm. And Devin, you gave it away, you seeing value in Premier.
Yeah, so we chatted food producers, and Premier to our mind is really kind of the preeminent FMCG producer in South Africa. They are growing through acquisitions, notably Rhodes through RFG recently. But I think what they're doing that we really like is improving their existing capacity, and that's investing in state-of-the-art facilities. And as a result, what we've seen is actually margin growth for them in what is, we've already said, is a very competitive sector. And so, their portfolio of brands is growing. They've got really strong brands to leverage off, Blue Label, Snowflake, and Nyala, that type of thing, and executing well in terms of their operations. And so I think you package that all together, and they've got a very compelling story for a local portfolio.
All right, let's leave it there. Thank you so much for your time and sharing your insights all the way from sunny KZN. Now, that was my guest, Devin Shutte from the Robey Group, as well as Aheesh Singh from MP9 Asset Management. Up next, it's The Close.